All right, guys. Good morning. Welcome to the session where I'm going to be going over mindset and building a strategy and how to get successful becoming a trader, especially in the cryptocurrency world. So, first thing foremost, start with the demo account. The longer you play with the demo account, the better. I'm still using demo accounts to practice. If I'm not comfortable taking a trade in a real account, take one in a demo account, watch the market, learn a little bit as you're going along. Now, this strategy that I'm using is swing strategy. Swing strategy ultimately is we're trying to catch, we're trying to go against the market to catch the pivot points. So as you see, market goes up, the market comes down. We like to buy it as it's going down so that we're catching the swing and going to the upside. So we're kind of like trying to get in before the market swings. We're trying to calculate using our strategy where we think that swing will happen. So I'm going to go, it's going to be, I'm going to start with the basics here. So there's going to be a lot of information. First thing I want to go over, lots of people have questions about this. I use the candlesticks charts. And so what that means is how you read this data is you have this as one candle here. So these blue candles signify the price going up. The red candles signify the price going down. On each candle, if we look up here, we can see that we have an O, which is open. So that's the open price of the candle. The H is the high, which is going to be the highest point of the candle. Then we have a low, which is going to be the lowest point of the candle. And then we have the close, which is going to be at the end of this time frame where the candle closed. So we call this bigger part of the candle body. We call the skinny part the wick. So I'm going to use this candle for an example. So this is where the candle opened. Would be right at the if it's a blue candle, the open is at the bottom of the big blue candle body, and the close is going to be at the top of the big blue candle body. So we can see that the open was at 36,872. My line is not perfect, but just right there. And then the close was 39,574. Not perfect, but it's right there. Now we see the high, 40,577. That's going to be indicated by this wick. So this is how high the price got, and the low is going to be indicated by this wick. So this candle is giving us a lot of information. It's giving us the full range that the price traded in within this. This is a daily candle. So within this day, this is the total range that the price traded. We opened here. So we opened at this level here. We may have come down all the way to here. We would have went all the way up to here, and then we would have ended the day at midnight UTC time at this level. And then the next day, same thing. We opened here, we closed here, but within this day, we dropped all the way down to here, and we closed. We went as high as up to here, and then we closed right here. So I had a lot of questions about that, so I wanted to go over that quickly. The line chart, I don't use it as much. It doesn't show as much data. It only shows where the price closed on that day. So you won't be able to see the full range of the price on that day and what kind of happened. So this will give you a lot more data. There are other, charts, the Heikin-Ashi. This is one that people use in Japan a lot. This shows kind of momentum more. A little bit more complex, I like to stick with candles. Simple gives you a lot of information and gets you job done. So the other thing, some people were asking me how to use the Fibonacci tool. So I'll quickly go over that. So if we hold here, yours will kind of look like the pitchfork at the start. If you click and hold it, you'll be able to pull up the Fibonacci retracement. To draw the Fibonacci retracement, you always want to make sure you're going from left to right. So from left to right, we go from low to high. And then from left to right, we go from high to low. Now, something to remember is if you're going from low to high, you're looking for a buy. And if you're going from high to low, you're looking for potential resistance or you're looking for short. So how you're going to set up the Fibonacci levels, the default doesn't look anything like this. But if you were to either double click on one of the Fibonacci lines, you'll get all these settings pop up. Or you can click on the little settings here. I like to have the trend line turn on, level line. I like to make it a little bit thicker so that I can see them better. I like to extend the lines to the right so that way I always, no matter where I am, I can see the Fibonacci actual levels on the right hand side and doesn't kind of overlap on my chart. I like to make the colors really simple. So then I turn off all of the levels that I don't want here. So I also go in and I changed a couple of the settings that were previously there to my preferred levels. So I added 0.886 and the 0.835. Then I'll remove the background. I like to add the prices so that shows the price at the end of the Fibonacci level as well. And then have the level set in value. I move the labels to the right and to the top of the lines. That just makes it clear for me so I can easily read the data, read the chart, and start planning my move. So that's a little bit of just the bare bones basics to how to get, set up with the trading view and the charts. And now we're going to want to build our strategy. So I kind of created this little checklist for you guys. This is going to be your trade strategy checklist. So the first thing you want to know is what time frame are you trading at? Here in TradingView, you can select all these different time frames. You can look at a chart from the 1 minute chart. You can build your strategy around the 1 minute, around the 5 minute. If you're going to be scalping, you're most likely going to be using a shorter time frame, somewhere between the 1 minute and the 15 minute. If you're doing day trading, you may go up to as high as the 1 hour. For swing trading, you're most likely going to be going off the 4 hour to the 1 day. So we're going a little bit higher time frame. For investing long term, you may want to look at the 1 week. This will show you good entry points to hold for a longer term. And show you the macro structure, macro trend. Then for the 1 year. For same kind of long-term holding positions. Let's say your time frame that you want to trade on isn't on here. You can actually just set custom time frames here. Like let's say I want to see the 7 minute chart. I can just add it. Now I have a 7 minute chart. So you can customize your time frames as you like here as well. So find out what strategy you're going to be using, and then determine your time frame. That's going to be the most important. Usually, I would also say, for your strategy, always double check your time frame with one or two. Double check your strategy with 1 or 2 time frames. So for our swing trading strategy, we are going to be using the 4 hour and the 1 day. So what that means is when we're charting, we're going to be first off using the daily time frame. And once we have our pivots set up, we have our zones, then we're going to be able to go down into the 4-hour, and we're going to be able to, when it's in our zone, look at the structure here to get potential entry, or we can even adjust our Fibonacci levels down at this time frame to kind of just fit them a little bit better. So that's the first most important thing. Know what kind of strategy you're trading and know what kind of time frame you want to be trading it on. So secondly, how will you find your edge in the market? So what is going to give you an edge? If you're new to trading, this may take you some time to kind of learn this, but the markets are made to um, make a lot of people lose a lot of money. And thinking about 95% of traders lose money while trading. So you have to know that the sentiment of all of these traders is usually the same. They all kind of come in when it's, things are booming and everybody's really excited and they all buy in. It ends up being they bought in right at the top. And then, they see the price go down and they're not used to this. And now they've lost a lot of money. So they just kind of either cash out and take their losses, or they just hold on for dear life and hope that one day it goes back up, right? So by learning the markets and observing, you'll see that the sentiment is always the same. Retail investors are always kind of going in and out of the same areas. So you don't want to be on the side of the retail investor. You want to have a strategy that's going to be, giving you an edge that everybody else is not going to have, right? So you want to be, determining what that edge is going to be, whether it's you want to, buy when everything is fearful and sell when everyone is greedy, or you want to, buy when there's momentum and breakups to the upside or to the downside, or you want to, some other kind of strategy where you're just long-term holding and you're trying to, dollar cost average in. Find what's going to give you your edge and stick to that. So at the Academy, we do the DCX package. We are swing traders. So our edge is we're looking to buy the fear and buy in when the market is going to swing. So if you guys want to get more information on that, let me know and I'll send you the videos in the Academy that will go over that more in detail. I'm just going to give you kind of like a basic rundown of it. Once, for example, the price of Bitcoin was at $42,000, everybody was super ecstatic up here. All the excitement, more people were buying in. People who never heard of Bitcoin before, they were like, oh my God, this thing's going up so fast and get involved. And all of a sudden it goes from 42,000 and starts dropping and dropping and dropping and dropping and dropping and dropped all the way down to like 31,000 or so, right? So a lot of fear came in, a lot of fear kicked in, a lot of volume. People were selling, a lot of people taking profits. Some people were just freaking out and just didn't want to be in the market anymore. They didn't know what they're doing. So here at this point, if any of you guys were trading, there was a lot of fear. There was a lot of news saying that Bitcoin's dead and all this kind of stuff, saying we're going to go back down to like 10,000. That's the point where you start buying, right? We want to buy this fear. We don't want to be buying the greed up here. We want to be buying the fear. So this dipped right near to our strategy, where our strategy tells us we're going to have the best potential for the buyers kicking in and the smart money coming in. So that is our edge. That's what we're going to be using as our strategy. So if you guys wanted to get, again, more information about the strategy and how we determine the levels and how we point them out, just let me know and I will send you guys the video in the Academy. Now, how will you be managing your risk? This may be the most important thing of all. A lot of traders will come in, they'll be hearing a lot of things about, oh yeah, use only 5% of your account to trade with and manage risk and set your stop losses and that kind of thing. But they don't really know what that means or how to do it. So I've created a calculator here for you guys. If you go to cryptoyyc.com, you'll be able to have access to this. There's a whole bunch of calculators here. We have the lot size calculator for MetaTrader, MetaTrader 4 and MetaTrader 5. We have the risk calculator here for exchanges, Binance, Bybit, BMEX, all of those. And then we have the US 30 and the Forex lot size calculators. This is if you're trading with Bitcoin account balances and you want to be trading Forex and US 30. So I'll quickly go over these and how to get these set up and what they do and how they work. I'll go over the exchange calculators because this is where most of us are going to be doing most of our trading. So let's say, we have our strategy. What risk management means, and when somebody says you only want to be risking, 2 to 5% per trade, let's say you have $100 in your account, right? 2 to 5% will mean that you only want to risk $2 to $5 on this trade. Now, where or what are you risking this on, right? You're obviously, you don't want to be just trading and opening a position worth $5 because you're going to get a really small quantity and really small lot size, and it's not really going to help you benefit and take advantage of the profits and the swings to the upside. So what this actually means is when we have our stop loss, we want to get a calculation that that causes us to lose as much, only $2 to $5 of our balance should our stop loss get hit. So when our stop loss gets hit, we only want to lose 2 to 5% of our account. So that's how we're actually going to be managing our risk. Now, it might be hard for you to calculate that. So let's say the price goes from 35,500 to 30,000. We want to put our stop loss at 30,000. That's a long ways away. I would recommend doing stop losses that are that or apart. But what you would do is you would come to the calculator and you would put in your entry price here. So let's say we're entering at 35,000. We're going to be putting our stop loss at 30,000. Let's see, you want it to risk 5%. What this means is it's going to do the calculations for you so that if the price goes down from 35,000 to 30,000, and this, let's say, is your account balance, you're only going to be losing 5% of your account should you get stopped out at this level, right? So that's what risk management means. It means that you're managing your lot size, your position, your entry, your stop loss, so that if you were to get stopped out on this trade and it does not become successful, you will only be losing that 5%. Now, if you lose 5% of your account, usually what that means is you're going to be, I like to look at it in the way of you're paying for information. You have your stop loss at a certain place for a reason. So once it breaks below that and you get stopped out, you're not upset. You're not kind of frustrated that you got stopped out, but you're more of like excited because you might be able to get more information now, maybe get an entry at either a lower price or a better price or a more optimal price. So that is why we use stop losses. They also protect you from losing more than 5% of your account. So the reason that we use a number like 2 to 5% is if you lose, let's say you had $100 in your account and you lose 5%, you now have $95, right? So if you lose 5% of 95, you're actually losing less than $5 now. So you're going to be losing $4.75. So you'll have $90.25. So you see, you'll notice like if I keep doing this calculation, 5% of your total is always going to be a little bit less than 5% of your original balance. If you just lost $5 each time, once you lose $5 20 times, you lose your whole account. So because we're using 5% of our balance, even when we get to $1 and we're losing 5% of our balance, we're only losing 5 cents. You'll never be able to lose your full balance if you're always using 5% of your account. Now, if you say you lose your first trade and you're down to $95, all you have to make back is about 5% profit on your 95 to get it back to $100. Okay. But let's say you have $100 and you didn't risk management properly and you lost 50% and now you have only $50, right? So you just lost half of your money. Now, to go from 95 to 100 is really easy, but to go from 50 back to 100, you have to double your account now, right? So it's a lot harder to double your account than to make 5% gain, right? So 5% is where that optimal kind of number is, where if you lose 5%, it's easy because you only have to make another 5% to make it back. If you lose 50%, you're going to have to make double to make it back. If you lose 75% of your account, you're going to have to make 4x return just to make back break even. So we only want to be risking 5% maximum. 2% is the recommended, because if you're managing your risk properly, you can have a balance to enter a position twice or 3 times if you get stopped out. Sometimes, we'll get stopped out 6 times, but we're waiting for that setup and waiting for it to swing. When we're looking at a 4-hour time frame, sometimes, our trade could hit our stop loss, multiple times without getting validated. So risk management is going to be the most important part. You don't want to lose all your money. You always want to make sure that you have money in your balance that you are able to make money from and be in the game. If you lose your whole account, it happens, as we're all learning, we kind of make some mistakes sometimes. But if you don't have any money in your trading account, you can't make any money back. So you're going to have to find ways to either fund it again or that kind of thing. So we want to mitigate the risk. We want to make sure that we don't get to that point ever. So big star on this category. Make sure that you have this figured out. So what I would do is I would take these questions for yourselves and actually answer them on a piece of paper, write down your answers, know exactly what your strategy is going to be. The reason we do this is because we want to take the emotions out of the market. We want to be trading without our emotions. Because as soon as we start trading with our emotions, this is where we buy up here, we buy high, and then we sell low, and then we just lose a lot of money, right? We want to be buying low and selling high. So when you're writing everything down and you're creating your plan, you stick to the plan, you have your structure, your strategy in place. So you're always going back to this guideline to be, okay, do does my checklist say I can enter here? Yes. Okay. Does it say that I can't? No. Okay. So I'm not going to enter here. I'm not going to freak out. I'm going to wait till all these parameters are set. And then, enter, and exit trades based on what you have kind of determined and only when you have determined beforehand. So next question will be, how will my position be entered? And the question after that will be, how will my position be exited? So by determining these as well, you're also going to be removing that emotion, because you're not going to be reacting to, seeing all these blue candles and the price skyrocketing, and you're freaking out because you're missing some money. So you just all of a sudden enter a trade. If that is your strategy, then by all means, as long as you have that set and it works and you've tested it, then go for it. But in my experience, that isn't the best strategy to have. You want to make sure that you solidify how my position be entered. The more parameters, the better, but I like to keep it simple. I like to, when it's in my zone, I like to enter. When I have my zone drawn out, I know exactly where my stop loss is going to be. So that's going to be how will my position be exited. It'll either be exited by a trigger of my stop loss, or it'll be exited when my take profits are set. So you want to find out what your zones are going to be for how my position be entered. You're going to have to write them down. Okay, when the price crosses below the 0.5 Fibonacci level, this is I'm not writing out any strategies. I'm writing to show you guys what I would recommend you guys do. So you would kind of put in a lot of parameters here. If the price doesn't drop below the 0.618, something like this, have as many, parameters as you need to for your strategy. But then, when you go back to your chart and you're looking, okay, can I enter here? You're going to look, okay, is the price below the 0.5 level? You go back, right here. Okay, yes, it was. Did the price go below the 0.618? No. We never went back into 6.8. So if all of these conditions are met, then you would say, for your last one, enter when the price moves at, across level X. So, so figure out what your strategy is going to be, how you're going to enter, and make sure you write it down. Make sure you're always going back and checking those parameters to make sure that they are valid and you're entering properly with your strategy. You're having these written down. It may seem, to some people like, oh, I don't need to, don't let your ego get in the way. Write this down at first. Always be checking it. Try to remove that emotion. Sometimes you'll still feel like, oh man, I really want to enter right now. I really want to enter. Like price is moving really fast. But if your strategy here in your checklist that you wrote down doesn't say to enter right now, know that you are entering without an edge in the market. So if you don't have the edge in the market, your probability of winning this trade may be significantly lower. It doesn't mean that you can't win the trade, but we're here to play a numbers game, and we're here to trade with high success rate, make the most amount of profit as possible, and not be gambling or risking your money away, because that means that's going to be less potential profit for our future trades. So how will my position be exited? This is also something to some people would argue that this is more important than how my position will be entered. I think that this is, so I like to put this question before. So how will my position be exited? What I know, let's say we're using our strategy, or you're using support and resistance or that kind of thing. Right now, looking at this chart, we could see that this little rectangle here is a good rectangle of support. This is where a lot of buyers kicked in. So what I would probably want to do is I would probably want to be setting my stop loss below this level, right? So if it does come near here, I know, okay, if we break below this box, that's a potential for, a really big reversal or a really big dump, and the price could be coming down all the way down to here, right? So knowing that my stop loss is going to be here, that's going to be one of the ways that my position will be exited, right? We can use resistance or support up here for depending if we're going short or long. So find out, how your position is going to be exited. For take profits, you want to also kind of do the same thing, but in the other direction. So you're going to want to find out where the resistance zones are. So right now we have a resistance zone right here. So you may want to, how am I positioned? So I'm going to say stop loss, and you want it to be right below support or resistance, depending on if you're going long or short. And take profit is going to be right right before we hit resistance or support, right? So this is just one, this is not really my strategy or anything. Again, I'm just kind of going through this so that you guys can know what you're doing here with how your position will be exited. Maybe for your take profit, you wanted to use some kind of moving averages when the moving averages cross over the price, or whatever your strategy is going to be. Write these down, where your stop loss is going to be, where what your parameters are going to have to hit, or price is going to have to hit, or something like that. Make sure that this is all planned out before you enter the trade, right? So depending on you guys and what works for you, whether it's you want to figure out where your position will be exited first or where your position will be entered first. Both of them work. Just make sure that you do write them out. Write them out in as much detail as possible. And when you are looking at the charts, you are using this as a reference guide to figure out when you're going to be entering and not. And then lastly, how will my trade become invalidated? Figure out, okay, if we do close, below resistance or support. So here I'm going to say if price of Bitcoin closes below the support on the 4-hourly time frame, and then let's say we want a double closure for our invalidation. So if the price closes below support on the 4-hour time frame, and then open and closes the next candle also below the support. So then here, okay, if all of these are met, you get stopped out. This is what we're looking for. Is my trade invalidated? So if the price does close below the support on the 4-hourly time frame, we know that we could still be potentially in the trade if we don't close the next candle below. So what that will kind of look like for this random strategy that we drew out here would be if the price comes down, but in this candle, it comes back up, then, this isn't going to be invalidated. But let's say the price comes all the way down, and then the next candle comes all the way down here per se, and then it closes there, and then it comes back up. This is still going to be invalidated because we matched our parameters here of the open, or the first closes below and the next candle opens and closes below. So now we've got rid of our emotion. We don't want to be entering this trade anymore. And we're going to be going back to finding out, okay, how my position be entered, and making sure that our entry parameters are met again before we enter a trade. So, don't let the ego get in the way. I do recommend everybody at least taking this, writing it down in your notebook, or having this in your notes somewhere. And whether it's on your computer or phone, but do write down the strategy. Test this out as well. You have a lot of tools in TradingView where you can play back history. For example, like I can click on this bar replay and I can go back to here, and all of a sudden it deletes all the history moving forward from here, and we can slowly add candles to our strategy, and we can be checking, okay, right here we may have validated our buy zone. So you're going to go back to your checklist, see, okay, do all these parameters work for this potential entry here? And they all do. You could see, okay, I would have entered here. Then you could also kind of write on a piece of paper, like my entry would have been, this is called paper trading. So you could say your entry would have been right here at 18,700 or something. And then you would say I put my stop loss, at, let's say 18,500. And then what you would do is when you keep pressing play and going through, oh, here we got stopped out, right? So you would put, stopped out. And then you could do it again for the next one. Did the trade invalidate? It doesn't look like it invalidated. Like if we set, this zone right here, so then we would have re-entered again. You would have write out entry again at 1870 SL 1800. Right result. And so what happened on the next time? And you're going to be able to watch, and you're going to be able to record what your results are, and you're going to be able to see, okay, does this strategy actually work? You can back test it. You have all this data, and then that can help you build that edge that you need against everybody else in the market, right? So you have, all these charts with all this data you can use to practice your strategy, to go through, the history, make sure that your strategy works, make sure you're testing it. You want to be putting in the work, right? This is, if this is going to be, just like a hobby for you or a side thing, then, maybe you just follow somebody who is trading. But if, you want to become a successful trader, a 7-figure trader, 6-figure trader, put in the work. It doesn't take a lot. You can spend a couple hours a day just, analyzing charts, doing some back testing and that kind of stuff. But ultimately, that determination and consistency is what is going to make you successful. Being able to accept a loss as long as, it's not, as long as you're managing your risk properly. That's one of the things a lot of traders have a hard time with. They get attached to their positions or that kind of stuff. Don't try not to have any attachments. Know that if your trade hits your level and you get stopped out, then it's completely fine. You're okay with that. But also, if your trade does get stopped out, you may have to work a little bit harder to get your entry. Sometimes it'll stop you out, 4 or 5 times. So you do have to be able to sit there, watch your position, watch your screen. I mean, you don't have to be watching. If your trade is, is up 300-400 pips and you move your stop loss to break even, you don't have to be watching it anymore. But you can set an alert, okay, if you get stopped out, so that that you got stopped out, then you should be coming back to the chart and putting in a little bit more work to maybe, check that it's not invalidated, and then re-enter the position. And then once you've re-entered and then goes up a couple hundred pips, you put your stop loss back to break even, you can go and go back to doing what you were doing. So it is kind of like a set it and forget it if you do get in your trade and your stop losses break even. And then from there, it could potentially hit all your take profits, right away. We have had that happen quite a few times. But sometimes it does make you work for it. Sometimes it does kind of fake you out, stop you out, pretend like it's going to get invalidated, but doesn't. And it goes back to the entry and you have to re-enter. So there is some work that you guys are going to have to do as well. But yeah, that consistency and that determination will kind of get you guys where you want to be. Again, make sure you're starting off with a demo account. And that way you guys are actually seeing the markets move in person, and you're able to take these trades with no risk of losing your own money. And then when you guys are comfortable, you feel like you've got the strategy down packed, move to a live account, put some money in there. And then the last piece of advice is, let's say you start with $100,000 in your trading account, or you start with $100 in your trading account. Treat that $100 as $100,000. And if it's $100,000, treat that $100,000 as $10 million, right? A lot of people are, when it comes to just, $100, they don't really care about it. They're okay with losing it. They'll spend it, on like the dumbest things, right? So, know that with your $100 or your $1,000 that you're putting in here, it can and will become $10,000, $100,000, $1 million one day. So if you can treat $100 the same way you would treat $1 million, then that $100 will become $1 million, right? That discipline that's required. That some people are, man. I mean, I remember myself. I used to go and gamble $100 like it was nothing. Some people are okay. They don't have that mindset, and I definitely had to develop that by realizing that $100 could technically be $100,000 one day, right? So, yeah, if you treat $100,000 like $100, $100 like $100,000, it'll help you keep that discipline that you need to make sure that you're sticking to your strategy, you're going back to your checklist, you're making sure that everything here falls in alignment, and then you're executing your trades and making sure that you have that edge. So, yeah, I hope this helps. I'll answer some questions now if you guys have, and we'll go from there.